In 1970, a cup of coffee cost 25 cents. Today, that's on average $1.60. This is inflation, but it's really not that simple. So what is inflation? Where does it come from? And how do you protect against it? Inflation has become a big word that is used a lot, but few understand what it really is. And that's because there are different types of inflation. But it is the silent killer of money, and it is actively put into the system. Now, nothing changed about that cup of coffee, but your money did. It is one of the main points to understand wealth as well as money, because it's the thing that builds wealth and evaporates your savings and purchasing power. Every single year, your money buys you less. Now, this isn't a system flaw. It's actually a target. And we have to understand that there is an inverse of inflation, and that is deflation. Deflation generally is very serious and bad, especially when it's at scale. There are also different types of deflation. Some deflation is good, and we see it readily in the economy. The good deflation is when the free market has lots of competition and they make better products for cheaper prices. But that is not widespread deflation that we worry about. The opposite of inflation is a cratering effect. When you have widespread deflation, think of the Great Depression, 2008. Now, inflation is similar. There's different types. Some of it is good inflation, and others is bad. Understanding the difference and how to protect against it allows you to see how you can use it to build wealth. Having inflation work for you, not against you. So, out of the gate, what is inflation? Inflation is the rate at which prices for goods increases over time. That is not broad-based deflation. And when you have individual items that prices go up, that doesn't necessarily mean we have inflation. The key is it's not one thing or even a category of things. It is when most things across the economy get expensive over a period of time. It is when they do it simultaneously and continuously. It is a sustained, broad-based rise in prices across the entire economy. Now, it's important to remember that the government actually targets inflation, meaning they're looking to get 2% inflation a year. That means that the prices should roughly double every 36 years. But how do they measure this? The main point is the Bureau of Labor Statistics. They track about 94,000 prices monthly in what is called the Consumer Price Index, or CPI. Now, the CPI is a basket, which includes things like housing, and they're weighted. So housing represents 33% of the weight. Transportation is 15%. Food is roughly 13%, medical care 7%, and then you have education, recreation, apparel, etc. Now, when we talk about things like housing, we have rent or owner's equivalent of rent. We're talking about the cost of housing for not just people that own it, so not just housing goes up, but also for renters. Now, this weighting aspect is very important to understand inflation. As we've seen lately, the cost of housing has been one of the major drivers of inflation. And when you take out things like housing, it paints a very different picture. Now, the way that it's measured and defined, that's where things get murky. And this is why you can have very conflicting views on inflation, especially today. But first, what are the types of inflation? The main one, being the one we're most familiar with, is called demand pull inflation. This is when you have too much money chasing too little goods and services. It's out of whack, and that pushes prices up because there's way more demand than there is supply. This occurs when the money supply itself grows. The money supply is the money that is circulating around in the economy. Now, how does this happen? This happens through a couple of ways. The first way is normal economic growth. And that's not necessarily a bad thing. Everyone's making more money, you have more people that are spending money, more companies that are producing, and so everyone is going up with those prices. But the main time we see inflation is when this leveling gets out of whack. And that is caused because money is coming into the system that wasn't generated in the system. That is when the government starts the printing press. And this is what we saw in COVID and continuing after COVID as the government spent trillions of dollars. We first began to see it when the COVID checks went out. At the same time, interest rates dropped, allowing people to borrow money. As debt is taken out, the money supply increases. Now, you may be asking, why didn't that happen in 2008? Because in 2008, we had massive stimulus and interest rates went to nothing. Well, the key is, in 2008, they were putting money into a system that had lost trillions of dollars, meaning before, the money supply shrunk and was shrinking rapidly. That was causing deflation. In order to stop the system from completely failing, they poured money into it. Think of it like trying to fill in the hole that was being created. That hole was being created because bankruptcies, businesses going under, and people losing their jobs, debt was getting wiped out, and people were being unemployed. Remember, debt is money. This cratering effect made money vanish. People didn't have income. There was no more demand for assets, goods, and services. This meant businesses started to fail. On top of that, the actual structure to deploy money into the system via the banks started to lock up, freeze, and fail. So the money couldn't even get into the system. This is catastrophic and can tank an economy like we saw in the Great Depression very, very quickly. You have to remember, it took 25 years for the Great Depression for us to actually recover from it. But with COVID, not only was there no financial hole, meaning there was no lost money, the money supply had been growing. The economy was doing good. People were able to loan. They could get debt, they could loan money, they were employed, and that money supply was growing naturally with the economy. It was just spreading, it was growing. Then COVID hit, but we didn't have mass defaults. We didn't have people losing their homes, businesses going under. Instead, the government backstopped the economy, dropped interest rates to a population that could borrow. This shot up borrowing. At the same time, government money was pouring in and the money supply grew, so there was way too much money chasing too few goods and services, and prices begin to climb and climb quickly. This is something we've seen before, which we will go over. But once again, one of the biggest drivers of that was housing. They could afford more because their overall payments went down because interest rates were so low, so they could pay more money, and they did. Now, the other type of inflation is the cost push inflation. You got to think about this in the terms of like the 1970s oil crisis, where all of a sudden the cost to produce rises and rises quickly. So it starts pushing prices up. This can create a shock to the system. Why? Because it made everything more expensive to produce, manufacture, transport across the board. So the price to even get the goods and services went up and up and up. And the third one is what I call natural inflation. It's really called built-in inflation. And this is when workers' prices rise because everyone's doing better. Higher wages, companies raise prices to cover wages, and it's a self-fulfilling cycle. But it's organic, it's led naturally, so it acts more as a balancing act. Now, when we look at this historically, we can see in 1980, we had 13.5% inflation. That meant that the price of goods and services was rising 13.5% a year. The federal government, in order to stop it, rose interest rates to 20%. Because remember, debt is money. So if you rise interest rates, guess what stops flowing? Money. And it worked. Rising interest rates to 20% killed everyone's ability to purchase, take out debt, and the money supply froze and then shrunk. 2022, we had 9.1% inflation. What did the Federal Reserve do? They jacked up interest rates. But why didn't we see such a curtail? Well, one of the main reasons was as interest rates rose, the government also rose its expenditures. They started pumping money into the system and offset the actual money in the economy. This meant that the money supply wasn't shrinking. It was artificial. Now, we've cooled down to around 3% as the latest numbers have come out, which is more in line with a historical average. But once again, still not a target. We're targeting 2%. But it doesn't feel like inflation's gone. Why? Just because inflation comes down, that doesn't mean that the price of goods and services that rose come down. It means the rate of growth came down. So prices of goods and services are still high because of the previous inflation. It takes time for the economy to catch up to that rise. Now, this is where the divide becomes so evident. You see, as the price of goods and services rise, that rises the price of assets. Now, this creates a massive divide in society from the haves and have-nots. Why? Because at the same time that people are able to buy less and afford less, you have the wealthy, who are the ones that own assets, becoming more wealthy because inflation is rising the price of assets. Now, this is a natural thing that occurs and is always happening. But in times of high inflation, it's a shock to the system because the disparity is so big. And this is why savers are losers and investors are winners. But when you have low inflation, it's not a shock because it just happens gradually to you over time. Meaning, gradually your money is worth less and less, and gradually the wealth are getting wealthier and wealthier. But in times of high inflation, it is very evident. So how do you protect your money? And how do you make inflation work for you? That's the key. You see, at the end of the day, the system, and all systems are structured, ownership is winners. The people that own the assets win. It's as simple as that. And it always has been. And it always will be. Why? Because if the businesses and assets aren't actually growing, nobody wins. Nobody is getting pay raises, nobody is getting hired, and if the prices of assets and businesses go down, the opposite happens. You have mass layoffs, defaults, and people stop buying assets, they stop reinvesting, and the whole thing ends. This is the balancing act that is always going on, invisibly behind the scenes, that we don't really notice until it gets so extreme. But it is always occurring. The only way to offset this is to own or be an investor. At the end of the day, if you own the same things that the wealthy people own, your wealth increases at the same rate. Meaning, if the major shareholders of Apple have their wealth rising at a certain rate, it's because the stock is going up. And if you own, you will also get that same increase. Historically speaking, the wealthy have been much more guarded because access was much more limited. But today, there are lots of options for people to invest and fractionally do it, meaning with little money. These opportunities didn't exist until the internet and technology came around, opening up access. And that's really important to know because you can do something about it. It doesn't mean it's easy, but you can start owning. This will help offset that effect of inflation, which is always there. To put this in perspective, historically, the stock market has risen at 10% on average a year. Some years it goes down, other years it goes up a lot more than that. But inflation historically has been 2 to 3%. That means that people that had money were losing their purchasing power by 2 to 3% a year, while people that owned stocks, their money was growing at 10% a year. Over a 10-year period of time, that's a staggering difference. Real estate also appreciates over time with inflation or outpaces inflation. once again, making the owners' wealth grow while the savers' wealth is dwindling. You have bonds. Now, bonds and treasury bonds are indexed to inflation, meaning it's a way that you can buy to protect the money from inflation, but you're not really outpacing it or doing a whole lot better, but it is better than losing the money's value. Individual businesses grow as demand grows, and as prices rise, they're getting the benefit of it as long as they can control expenditures. So businesses redeploy capital, become more efficient, therefore outpacing inflation, making the owners of the businesses wealthy. The important thing to remember is inflation's not going to go away. It never has. And if it does, that's actually a whole nother problem. So, like gravity, we understand that if I jump off a building, it's gonna hurt. The same thing is with this economic principle. If I save money, it's gonna hurt unless that money is invested. So, investing not only keeps you safe from inflation, it actually outperforms and outpaces it. What's important to realize and know that investing is not just for the wealthy anymore. Investing, you can start as little as $100 or less, and you can do that in lots of different ways that were never available today. In fact, I made a whole video. You can check that out here on ways that you can start investing fractionally in own businesses, real estates, and all sorts of things from your computer. And as the future goes, today when we look at inflation with the latest numbers, inflation has come down, but prices have not. And they're not really going to come down, except for certain goods and services that the market is competing and dropping prices. Services that are tied to the government and are in a high regulatory environment, they have the opposite effect. They actually go up faster than inflation. Think housing, medical, and others, like college, all three of which far outpace inflation. There are no economic factors to allow those prices to be driven down. And so they can not only outpace, they can double, triple, quadruple. This is devastating to the American people, considering the weighted average of these items, like housing, medical, and education, which tend to be the largest percentages as a weighted average in inflation. All three of these have exploded over the last 20 years. This creates a massive negative effect on everyday Americans and consumers, because not only are their savings dwindling, this is outpacing far and above inflation, and their incomes aren't rising at the same time. So my question to you is, what is your hedge against inflation? What are you doing today to not only offset the effects of inflation on the money that you're earning, but also grow it so inflation works for you instead of destroying you? So you want to learn all the things that you didn't learn in school about how to actually be successful and receive financial advice. Make sure you like and subscribe to this channel so you can understand how the world really works.